Hello, everybody, and welcome to the Gold Rush. I am Sam Gatlin, an analyst at All Star Charts, and I am joined, as always, today by my esteemed colleague and co-host, Mr. Jason Hers. We have a lot happening in the markets. Risk assets are really taking it on the chin today. You're not really seeing a bid for the bonds at all, Jason. I find that kind of interesting. Maybe that's why energy continues to be the relative strength in this market.
Wait, I
So we'll
thought we
talk.
were all supposed to buy bonds, Sam. I thought that was like that what everybody keeps saying, like, and I'm crazy for being the bond bear out here, and you and me are just crazy guys. So I keep hearing we're supposed to be buying bonds, but they don't keep
Yeah, I think
not going
the
anywhere.
people that say that, Jason, are the ones that listen to the talking heads at the Federal Reserve. They're not looking at the charts. We have some charts today that will show you all that show that bonds are very much in a downtrend, and that has not changed despite all of this noise that you hear out of the Federal Reserve and how they're cutting interest rates. All of that is just complete noise and not helpful. We're seeing interest rates hold in there steady, and based on some of the intermarket evidence, I think we could see new highs for the bond yields maybe as soon as next year. I don't know, Jason. Gene, if you will, my good man, throw up slide number two. I think this is a good place to start. So this is just a long-term look at the US 30-year Treasury yield. And you can see that it moves in long cycles. You can see that from, I think it was 1940 or the mid 1940s when the yield bottomed and entered a new 40-year uptrend. And then you saw a peak around 1980, and then you saw a steady decline until 2020. And 2020 was really a big deal in the bond market. It ended that massive downtrend in the yield. And I think yields are in a new uptrend for the foreseeable future. Maybe this would be a good time to talk about our good friend's report that he put together about the tail that wags the dog, Mr. Stephen Weitzel. Jason, I know you're a big fan of Stephen Weitzel. You want to tell us about that report he put together? Because I think it's so good, and not enough investors are thinking about the bond market the way that Stephen and people like you and myself think about it.
Yeah, Pavlov's new dog. Man, so I did a presentation that was basically like I had to even ask Steven before I did my presentation on bonds and group psychology if it was okay because like it was inspired by his presentation or his idea of Pavlov's new dog, and I kept begging him to finish this thing. Like it was probably good, what, 6 months or a year. I was like, dude, please finish this, please finish it, and it came out really good. I mean, he's such a smart guy. But the idea is that so basically what we're looking at here, yields topped in 1982. If you look at the stock market in 1982, what happened to it? Well, the stock market basically went up from 1982 on, I mean, to where we're at today. But what did change is COVID in 2020. We started to see this inflationary cycle come into play, which is another 40, basically around 40 years, 38 years exactly from 1982. So the idea of Weitzel's writing was the idea that so many investors, whether it's financial advisors, people who run the industry, you're talking about the big banks and so on, like they've been stuck on this 60-40 portfolio idea and they've been winning because it's been the way to go and the market's frothy. Bonds usually pick up the slack. When bonds are slowing down, the market picks up the slack. And you've been able to do this for the last 40 years. So portfolios have been built this way for a long time. Now that's changed. Now we're seeing a shift the other direction where like you can't just have you can have a 60-40 portfolio if you really want to, but you're just not going to make any money. So the idea is that I don't think a lot of investors can change. Like I don't think they're at the point where like they are going to just shift all of a sudden. They're going to be like, hey, let's go 40% gold. Let's go 40% energy stocks or something. I don't think they're going to shift until it's probably too late Probably like in 1982, like basically the thing that was 76 on, we see this massive parabolic move in bond yields. I think when we see that move, we'll start to see the rest of the investors finally go, oh, you know what? We probably need to be out of bonds. We probably need to do something else. But we have seen some interesting developments, though, this time around, which is globally, central banks are buying a lot of gold. That's something that's a big change. So that's something to keep an eye on here. And also the fact that Morgan Stanley came out and said, like, hey, we should have a 60-20-20 portfolio, meaning 60% stocks, 20% bonds, 20% gold, which is a big
Is
shift.
that the first you've heard of a big um, firm like Morgan Stanley saying something like that?
Oh, yes. Yes, for sure. Like I haven't heard anybody else say anything like that in, many years. I remember you got to think back to Harry Brown, the permanent portfolio. This was in the 70s, and he started saying, like, hey, we should have portfolios as 25% US stocks, 25% international stocks, 25% gold, and 25% bonds. And, that sounded crazy at the time because we were talking about 25% of gold in your portfolio. It just sounded nuts. And really, that portfolio has performed well after all this time, after all these years, which is pretty amazing. But at the same time, like somebody even stepping up an allocation for a big firm over, I haven't even seen over 5% in my whole career. So I haven't seen over 5% in my whole career. I even going back, I can't think of anybody saying that like during the dot-com bubble. There was a couple things that started to come out where a couple people made moves during 2008 to 2011 saying like, hey, we could do it this way now. We could add more gold to these portfolios. But that's been a long time. So haven't seen it since basically the beginning of my career where there was a little bit of it, but not to 20%. That's new.
That's really interesting. I hadn't heard that, Jason. Let's move on to the next chart here. This shows that same chart we were just looking at, but this is more zoomed in over the past few years, looking at the U.S. 30-year Treasury yield, and then you have the federal funds rate. Everybody knows the Federal Reserve has been cutting interest rates, but the bond market hasn't flinched. You're seeing a series of higher lows in this 30-year yield. And, historically, the bond market has called bullshit on the Federal Reserve. And I think that's exactly what's happening right now. Do you think different, Jason?
No, I think you're exactly right. When we look at this chart, it's just what I'm highlighting here is the idea that sometimes the Fed is behind the curve. Most of the time, the Fed's behind the curve, to be honest. And when that happens,
Have they ever been ahead of the curve, Jason?
have they ever been ahead? I'm sure there's a time. I'm sure I could go back and be like, look at this one time. Because if I say no, somebody's going to be like, there's this one time they were doing great. Like most of the time, they're always like cutting rates a little bit too late or raising rates into like a recession. So to 2018, they're raising rates into nearly a recession at that point. A lot of people, we would have probably went into a recession right there, but they started to lower rates immediately. Not to mention, Powell came out December 2018, and said, we're finally neutral after 2 weeks before that, saying we're a long way from neutral. So somehow between not changing the interest rate, we became neutral again. Nobody knows how that was possible, but it basically bottomed out the market. We started doing reverse repos, meaning we started adding liquidity to the banking system. In August of 2019, the market kind of continued to roll higher. And then we started cutting rates around that point. And then 2020 happened, and then we cut rates all the way to zero. So cut rates all the way to zero. Now we're here in 2020. You see the green arrow again pointing up. So they're holding rates steady. They're doing quantitative easing infinity, basically. I mean, they even said it's QE infinity. And as they're doing this, the bond market, the long-term bond starts moving higher, making higher highs, higher lows, starting trending higher. And they keep saying inflation is transitory. Oops, moved my camera. There we go. They say inflation is transitory. And so after they're saying inflation is transitory, now we're kind of in this next zone of, okay, well, then inflation just takes off and never looks back. Yields take off and never look back. And now where we're at today, where we're once again seeing this divergence going forward. So now we're seeing this divergence again, and the long bond is starting to move up, even as they're cutting rates, even as they stop quantitative tightening. I'm pretty surprised about this one. So this was one that to really pay attention to here. We'll see where this ends up.
Totally. Jason, we have a really interesting question in the chat here saying GLD, SLV, PPLT, and PALL. So that's gold, silver, platinum, and palladium are down 4 to 8% over the past month. Why? Um, we were on a call in the last hour, and you said something that I thought was really interesting. You think this is more just a liquidity thing more than anything. And you know, some people think mistakenly that gold is the safe haven. You know, it's it's not. Like in times of true market stress, you can look at the Great Financial Crisis as an example. Gold got absolutely crushed because it's driven by liquidity. That's when it really thrives. And right now, there's liquidity coming out of the market. I think something like crypto is probably the poster child of that. You know, there are no fundamentals in crypto. It's just purely driven by liquidity in the market. You're seeing Bitcoin get the shit kicked out of it because liquidity is coming out of the system. And these precious metals have held in there a lot better than Bitcoin, but you know, they're not immune to the selling pressure.
Yeah, I mean, I would think about gold as the safer haven, not the
But
safe
it's not
haven.
the safe haven.
Yeah,
Like
yeah,
during
I would think
market
about it.
crashes, you'll see the dollar rally, and then that's it. Like,
Well, yeah, exactly. It's just going to go down less, and that is valuable. Like if you're a very long term investor, fine, that's valuable. But you know, you will see it come down as well. Like, and it's come down less than a lot of the stocks out there and a lot of the sectors out there. Makes a lot of sense at the moment. But you know, if we look at it, you know, historically, liquidity events mean what? Means people need money. Means that big banks, big funds, they need the money. And so what are they doing in those scenarios? Well, and once again, we're not going to know exactly what's happening. Are they blowing up? Did they do some crazy practices like in 2008 and so on? Like there's a million things we can speculate, but we won't know until after, most likely. But we have to understand like they're looking for money at certain points. And when they're looking for money, they're selling their books. They're going, okay, they're even going to traders on their own desks and going, okay, we're selling out of your book right now. We need the cash. We need to raise cash. Everybody needs to raise cash. And that's the scenario I think we're in right now. And usually those are short lived. It's not something that just like kind of continues to break. So I do think that this is, unless it's like a COVID style situation, unless something really big is happening, I don't foresee that at the moment. I see it, you know, coming up in the future, which means it could be now, but I really doubt that. I think this is more of a short term sell everything, a lot of volatility. Primary trends are holding up in most things out there. I think we'll probably head higher at some point into the end of the year.
yeah, and you have been talking a lot, Jason, about the United States dollar and how you are absolutely not flinching on how you think the dollar is going to break down from here. And I think this chart explains exactly why, but you know, there's a lot of people out there that are taking the other side of your position. You know, a lot of people think the dollar is going to break out above 100. So, why don't you just remind everybody why that's probably not the case?
Well, so number one, I will say I don't have a crystal ball.
Totally. You are
Me
you
or
know,
Sam,
yeah.
but
You're willing to change your opinion if the market proves you wrong, right?
yeah, but well, I mean, but I am the smartest person on earth, so there is that. Uh, but but no, just kidding. But for real, when I am looking at the dollar, like, is there a possibility the dollar could rally a bit more here? Yes. You know, there's a difference with going like, I know what's going to happen. I know this level is going to stop it. It might stop it. I would look for that 101, 102 level to really stop this rally. But to me, it's more of a structure. I don't think the structure of the dollar is going to change to higher highs and higher lows. I think that big drawdown that you're seeing on the end of that chart, I think we might hit maybe the middle of it, maybe the 61.8 retracement of it. Something like that would be normal to me. I do
So
not.
really like a breakout above like 110 on the Dixie would invalidate your thesis?
Yes, I don't think we're going to get anywhere near that. I don't think we're going to start getting above 110. I think we'll continue to put in higher or lower highs lower lows. I think that's going to continue to be the trend. That's because the yield curve and the way it's shaped, and not to mention they just stopped quantitative tightening. They're cutting rates. They're going to continue to cut rates. It's politically motivated now for them to cut rates. I can't see a scenario here where the dollar just gets strong and just takes off and this turns into a new uptrend and we're hitting those, old highs from what, 2016 or whatever that was. Or sorry, that's all the way back further than that. That's 2000. So I don't see a scenario where we're going to hit those highs. I don't think we're going to hit the highs from even earlier this year. And it's just because of the structure. When you're seeing the yield curve steepening like this, you're seeing liquidity being thrown into the market. And so as we're seeing liquidity thrown into this market, there's not a scenario where that usually leads to a higher dollar. I mean, if you look at the chart, you can see that again and again. But once again, it's a continue to wait and see. Is the market, is the dollar sniffing out that the Fed is all of a sudden going to have to start raising rates, or they're going to stop lowering rates? That's possible, but I don't think that's happening anytime soon. I can't see it. Like most people would say the same thing. Like even if you're on the opposite side of this trade, you'd say, well, I can't really see a scenario where the Fed's going to stop lowering rates. And I think so too. But as long as you think that, the yield curve is steepening and money is loosening. Yes, when we have pullbacks, and these bounces in the dollar are very weak for the pullbacks we're having. This is something to actually say. These are fucking weak pullbacks, to be honest. Like fucking weak pullbacks in the S&P 500, very weak buys in the dollar. And we're seeing these little bounces in the dollar. Like that should be a big bounce in the dollar if we're getting a real rush into safe haven currency. And if people are rushing to the dollar, like we would see big bounces, this thing would get above 102, 103 pretty easily. But I don't think that scenario is going to happen. I think the highest probability bet here is that we have a lower dollar here. It starts to stall out at some point between here and let's say 104 would be the highest level I would think it could possibly hit within this trend, and then move lower. And I think we'll probably see the energy sector move higher. Copper miners move higher, steel stocks move higher, lithium move higher, solar stocks possibly move higher with it. That's the scenario I think is very likely here.
And here's another chart that I really like to just look at the dollar. Over the longest of time frames, gold and the US dollar have a very strong negative correlation. And right now, gold is hanging out near all-time highs, while you have the US dollar index, hanging in there really strong. But, based on this long-term correlation, I think there's a major vulnerability to the dollar to catch down, because this is an inverted chart of the US dollar index. So as this line's going up, that's actually the dollar going down. So what do you think about this correlation? Is this just it's not really causation? Gold isn't really that much of a signal for the dollar, or do you think I'm onto something here, Jason? Is this a bigger deal than I'm making it?
I think that gold is significant in a lot of ways, and it can move in a lot of different environments. Even like as early as recent as 2018, 2019, we saw a strong dollar, and we also saw strong gold prices at that same year. So we can have those type of scenarios. Is it a scenario today? I would be very surprised. Those dynamics have shifted. Basically, what happens is you run into these debasement cycles, and everybody's kind of worried about, is the dollar going to collapse? What about currency? And this is what was happening, not in the United States, but globally during 2018, 2019. So people are rushing out of their currencies, getting into dollars. You'll see gold and the dollar move up at the same time in that scenario. Today, we're in a very different scenario where these other currencies are actually getting stronger. Other countries, even outside of their home countries, are buying foreign currencies. That's happening. Not to mention, they're also buying gold at a very heavy clip. I'm not talking about the gold price. It gets confused sometimes. I'm talking about the reserve holdings of gold in countries. That has gone up a ton. Sam and I have covered that a couple times, but we're at, I think, 30% reserves currently. We haven't been at those levels in, I want to say, 30 years. So it's been a long time. So I do think that this is just a different scenario where the dollar isn't going to really if the dollar got very strong, I think it would put some pressure on gold here. And I think that correlation will probably be a little bit more inverse going forward.
We have my brother actually is in the chat, Elijah Gatlin, asking if we've seen Vietnam. He says they have the highest premium to spot in the world. Government is limiting purchases. I think he's referring to gold. Jason, I know this is something you track during these gold rush moments. It's typically a sign of euphoria whenever there's a massive premium at these shops where you can buy precious metals. I've seen some things about that happening, but I can't say that's something I track very closely. I think that the JC sentiment indicator is another good one. JC's never bought precious metals, but when he went to Las Vegas, he bought some silver bullion, and I think that marked the exact top in precious metals. I'm not saying it's the top forever, but tactically that was the top whenever JC did that. So, have you seen anything else on that front? Are you familiar with the situation in Vietnam?
Vietnam got kind of crazy for a minute. That slowed down recently, but like globally, we were seeing this rush to buy more gold for a little while. Like that did happen, like right near the tops. And Sam and I came out with a post. Sam had a great chart talking about the volatility of gold. We were talking about the possibility of a pullback there, consolidation, and we'd probably see it. We did get that pullback. We timed that very well. Sam's chart was perfectly timed for that. So, I think that we did get in a very frothy period, but in the United States, did we? No. Like none of the gold dealers that I talked to had like lines out the door, a bunch of people running to either buy or sell gold. Nothing has happened yet in the United States, which is what I would want to see if I was going to say this is a mania, this thing's coming to an end. So I don't think we're seeing a mania yet. And that's basically it on that. But
we have Grant
on.
Hockridge in the chat now.
Nice.
Shout out, Grant. What's up?
What's up, Grant? That's
Jason,
boy.
I think we need to finish today's show with some energy talk.
I was going to ask Elijah about the matcha. Like you mentioned the matcha, and all. Is he one of those?
No, I think that's more my little brother.
Little ones?
We were talking about matcha before we got on here.
You guys are old. That's why you guys don't know. Like I'm young.
I'm more of like an Earl Grey tea kind of guy. But
you sound like you're like 80. That's fine.
It's good stuff. No, let's talk about energy. Energy relative to the S&P 500 is breaking out of a multi-year coil. And you can zoom in on this and see a more tactical base for energy relative to the broader market, flirting with new multi-month highs. And this is something we've been talking about for as long as I can think, Jason, really since gold broke out and rang the dinner bell for this commodity cycle. We've seen gold break out. We've seen copper break out. Copper miners are absolutely ripping. When's energy's turn? Everybody wants to know, Jason.
Everybody wants to know. I will give you the time. I will give you the time. I will give you the date. No,
man, Jason, this is something I don't think many people have noticed, but if you equally weight the energy complex, crude oil, heating oil, gasoline, and natural gas, and looking at the weekly volatility, the Bollinger Bandwidth, you can see it rarely gets compressed like this. I think we know for a fact that a big move is coming in energy, and I don't think it's to the downside.
This is what we've been looking at for a long time. If you have a Bollinger Bandwidth as tight as it ever has been on the CRB index, you're looking at this equal weighted index. Same thing. Like we see this over and over again in this whole sector. Do I know the exact time frame that this move will happen? No, because and let me explain the Bollinger Bandwidth indicator a little bit because people keep asking about this. People see it and they're like, well, that indicator doesn't look like it works, because they think of it like RSI or something, or oversold and overbought levels. And what this tells you is that volatility is tight, meaning the price is in a very small range. What that leads to is a big move. Will it tell you the direction of that move? No, that's what you use your technical analysis for. This is why Sam has that level there. Get above $7, like this thing's taking off to the upside, and that's when you buy it. But this is just basically telling you we're in a range. There's no volatility, meaning not a bunch of interest. Nobody's really buying or selling it heavily. Everybody's skeptical about it. Sentiment is getting worse by the day. And then you get that breakout above 7, and this thing's probably not going to look back. So, that's a way to think about this. I think the whole energy complex looks the same. Like it's like you look at XLE. That's also, if you put on probably a monthly indicator, you probably have a pretty tight bandwidth too. So if you look at XLE, you get above that 101 level is the long-term level, 97 is the short-term level. Get above either one of those, like depending on your time frame, start to buy that thing. Short interest is high, like Sam's showing here. Sentiment is terrible.
People hate energy, Jason.
People hate it. Yeah. So it's going to be a great trade at some point, but it's once again, just like the chart before with the gold, copper, oil. It's just waiting for that next leg to happen. Gold, copper, oil doesn't tell you the time frame of when you take the trade. The chart will. And now the chart's telling you above 97, take that trade. Definitely want to buy it. And some of the stocks in the energy sector already look good and ready to go. So we've been buying some of those and looking at even more of those at the moment. So that's going to be something to keep on the radar, not to mention the relative strength. This is important for everybody. This is a little lesson. When you see a pullback, this is when you kind of hit that next level of trading. At the beginning levels of trading, you see a pullback, you're scared, life is over, you're trying to short everything. You think it's the end of the world. When you get some years in trading, you start to go, okay, well, what's actually holding up? So you start to look at the whole landscape in the macro universe, and you go, okay, well, energy stocks are holding up pretty well. Gold is even holding up pretty well in comparison to the S&P 500. International is massively doing well against the S&P 500. We're looking at, I think Argentina's up 20 something percent compared to the S&P 500 over the last month. If we're looking at,
that's a little different. They just had that massive earnings gap on the.
Hey man, I will take it and I will use the data point because the data is the data, Sam.
Hey, you're cherry picking. I'm calling out your bullshit.
I'm not cherry picking. I got more. I got more.
It's like all of Latin America.
Yeah, that's what I was gonna say. Like it's not just Argentina; it's all of Latin America. We're looking at like between 10 and 20% returns against the S&P 500 in most of Latin America. That's pretty significant at the moment. So, I want to pay attention to these things and go, okay, what's happening? Not to mention, okay, look at the dollar. The market's selling off. People aren't rushing to dollars like I would think they would. So that's also another negative for the dollar. So I think that the international trade will probably pick up at some point. I think the energy trade's already telling you it's ready to go. I think things like gold miners, copper miners, like these areas are holding up better than other areas in the market, and solar stocks and lithium look really good right now. So those are other areas I want to keep an eye on. But as this think about it this way, go back to 2020, semiconductors were the best performing. Like if you do SMH against the SPY or the COVID crash, it doesn't even go down. Like it looks like it's just in a solid uptrend. And it was one of the best performing sectors that year in 2020 after the crash off the lows. And same, look at, go all the way back to what we were talking about gold, like in 2008, gold and gold miners were some of the held up better than a lot of the other sectors in the S&P 500. And next thing you know, gold was the one taking off after that. So, and not to mention this year, Liberation Day, a very recent memory. What held up best earlier this year? Well, international stocks did, gold, silver, gold miners, and what ended up leading the way the rest of the year? Well, those sectors. So once again, you want to kind of watch what's pulling back and understand where you want to be because of that.
Totally. Yeah. Money rotates to where it's treated best. I think that's such an underrated cheat code for the market. It's really not hard to do. You just you divide one asset by another, and it gives you so much information. So I'm glad you said that, Jason.
Well said.
Yeah, man. Well, let's finish there. That's a great note to end on. Everybody, if you want more Gold Rush, we will be live again tomorrow at 4 p.m. Eastern Time for a special live stream with Jason Pers and Mr. Steve Straza, the one and only legendary Straza. It's going to be a great live stream. This is not something you want to miss. So make sure you join us 4 p.m. Eastern time tomorrow. I just want to shout out everybody in the chat. We really appreciate you being here. Elijah Frey Lee, Mr. Grant Hawkridge making an appearance. Robert, thank you, all of you, for being here. We'll be here again next Thursday for another Gold Rush live stream. But until then, stay safe out there, everyone.
Later, guys.